Happy December, everybody, and welcome to our Investor 360 program. This is a program that's assembled as a partnership between Stubbs Alderson and Markleys, the firm that runs the Preccelerator program, Trinet, Silicon Valley Bank, EMOLA, and Early Growth Financial Services. I don't see any of our partners on here right now to call on them, so without having a bunch of commercials, I will let you know that the Preccelerator is an early stage accelerator. We work with pre-revenue, typically companies that come in and work on their MVP and get to product market fit. And then we help get them launched and put them in front of investors like Mark and others. But today I'm really excited to have Mark Linao from the Progressive Fund to talk to us about what he's doing in the marketplace. And it's going to be a fireside chat way of doing this. So I'm going to pin Mark up here so we can all see him. There we go. And I'll pin myself so you can see me. And so good morning, everybody. Good afternoon. Mark, how are you doing today?
Good, doing great. How about you?
I'm doing terrific. It's as we go into the last part of the quarter of the last part of the year, we have a couple of weeks left. I know everybody's probably scrambling to close deals and get all the work done by year end. So I appreciate you taking time during this busy period. Fundraising never stops, I would imagine. So why don't you kind of give us a little bit of your background and how you came to where you are today with the Progression Fund?
Yeah, so I guess thanks everyone for coming and attending this. My background, born, raised here in LA. I had been in venture for the last around 7 years now. I first started in venture capital. Well, I guess let me take a step back. I used to be an aerospace and materials engineer prior in a past life, and I wasn't exactly happy with that type of work anymore. I was, my products were like the missile defense systems, missile guidance systems, and cloaking systems for some of the fighter jets. Left that to go pursue a job and to go do two things: potentially be like a consultant, and to explore what else was out there. So I did two things. I applied to business school, and I also applied to a startup. I liked my time at a startup, and I got into business school. So my plans kind of changed. I wanted to work at a high growth tech company. The startup I worked at ended up going public, I think 2 years later, while I was in business school. And I had worked at Amazon, and I was supposed to go back to Amazon, but got a job in venture, and to come back in LA. So spent a lot of my time. I used to be my first job in venture was an associate at a company called Technicolor, which was based here in LA. They're a French company, and I was running a lot of their media. And yeah, it's a Technicolor that invented color in film. And for them, it was about investing in interesting companies at the intersection of entertainment, media, and technology, content creation, etc. It was a different time back then, 2013, 2014. We saw a lot of shift to video content creation being on mobile phones, and e-commerce penetration was like accelerating. So investing in things that made sense there and kind of fit that thesis, and also spent a lot of time in AR and VR as well. Since then, I worked for I ran the investment group for the US investments for a company called Akatsuki. They big mobile game developer. They created Dragon Ball Z. The main mobile game developer for Dragon Ball Z on the mobile phone, and they were one of the first mobile developers, game developers in Asia. So as the iPhone took off, they took off, and they were kind of also looking to invest in interesting new technologies so they can get ahead of things. After that, I left to go start a fund called Progression. So after investing for kind of like, I guess I want to say 4 to something years in corporate venture, and I wanted to go start my own thing and try it out on my own. So I started Progression with the guys who were really early and executives at the at Musical.ly, which became TikTok. So yeah, so some of the things we look at Progression are like I look at a lot of gaming entertainment, but we have an angle and a bend on consumer social and social, I guess, next generation consumer social companies. We think that could be found in games, new apps, and who knows what the next kind of TikTok looks like. Yeah, I'll stop there. But like I said, based in LA, most of my partners are, I think half of us are in LA, and the other half is one is in Tokyo, and the other person is in SF. So yeah, it's nice to meet everyone.
Great. Thank you for that background. I think one of the a couple of the things maybe you left out that I think are interesting. That you have your master's in engineering, and you come at this from at least you have a scientific mind. And I think a lot of investors sometimes don't have that background. So it's nice when people are looking at things with that scientific method, or just looking at how companies are put together. Do you think that actually helps you?
Oh, it totally does. It's interesting you asked that question. I was on a hike this morning with someone, and they were building a battery company. And as a material scientist, I knew quite a bit about that, but I don't invest in the space, right? So it does help. I'd say that, like, especially my time at Amazon, where I did a lot of communication, and I built an algorithm for them on how they deliver back in 2013. And speaking with companies right now, I could speak kind of the engineering language and talk to the software developers, things like that, and understand what they're talking about. I can't code per se anymore. I wouldn't know how to. The last time I coded was like some old language that I was using to code a robot to assemble things. But the nice thing is that at Progression, we like to get involved with product, so I can kind of speak the lingo and understand product from an engineering standpoint, and also from like a market consumer standpoint, because that's what, I kind of feel like I'm in between those two worlds, and that's where I need to find where those two make sense for consumer experiences.
And so let's talk about Progression for a little bit. This is a fairly new fund. And how big of a fund is it?
We're raising our second fund, which is a $50 million fund. Our fund one was a little bit under that, which is a lot under that actually, but yeah, a $50 million fund. And I guess, yeah, what can I tell you about it? What do you want to know?
So, well, I mean, you have what, 19 companies in your portfolio?
We've got more now. We've got 20. I think we have 22. I want to say. I'm doing the official count later today. We have 22 to 24, and we're starting to invest out of the second fund now. And yeah, we primarily focused on pre-seed and seed checks at the time, and now we're raising a bigger fund to lead, and we've seen valuations creep up, and we think we need to keep pace with the market, and we want more. I would say in venture, we reserve a certain amount of capital to deploy into the I guess the winners and the high growth, and maybe even sometimes companies that need help. So we're making more room for that.
And is there, in looking at your portfolio, is there a common thread of industry or what they're trying to accomplish, the problems they're trying to solve?
Yeah, definitely. I'd say, like, if you can, we've got a little bit of time here, so do you mind if I kind of walk through our thesis? And
sure.
Hopefully the audience doesn't think this is boring, but the way we think about investing in companies at Progression is our thesis, as we take a step back, is we invest in, we think 3 things are driving consumer, I guess, change and behavior change. It's one, the first thing is generational differences. So there's a difference between what Gen Alpha or Gen Z or myself, like a millennial, likes, and how we buy and purchase things. The second variable we talk about is technology adoption. So probably most of us here saw what happened when the internet, when we came online, how we went from computing, and computing went smaller to mobile, to e-commerce, etc. And now we're seeing like blockchain, AR, VR, things like that. And then the third thing that we think that drives change, the third variable, is historical events. So the way we categorize that is like, if you look at what happened in 2008, and if you listen to like Toby Luke from Spotify, the driver for Shopify, the driver for his company was the Great Recession, because people were displaced from their employers. They had to figure out ways to make money on their own. And because he provided that service where you could spin up an e-commerce brand with a few clicks of a button and a credit card swipe, we think that's the same case. And now we're kind of seeing what happened last year, right? With the social unrest, the kind of talks about equality. We're seeing a lot of preferences in brands, and the younger generation are buying different things that it's almost like they stand for those brands before they make those purchase behaviors. And then we saw that what happened with the pandemic, right? We switched back to our second variable I talked about. It was like we all had to be remote work all of a sudden. So those are the three investment, I guess, like variables. And then category-wise, the theme, I guess, as a follow-up to that, we look in three different behaviors. Play, so that's like social, gaming, entertainment. How are people spending their time now? Spend, we see a lot of interesting innovation in shopping. There was live stream shopping. I'm a first and early investor in a company here called Pop Shop, which is a live streaming commerce company. We see a lot of innovation in group buying, like with Pinduoduo in China. So, and we're seeing interesting transactions now take place because of what's happening in blockchain and things like that. And then we have a third behavior, which is called lifestyle, and that's more about like how does this next generation think about taking care of themselves, taking care of their parents, online education, how do they build credit, how do they think about buying homes, or do they want to buy homes? So you take that kind of, I know that's kind of a mouthful there, but we take all that into consideration if companies kind of meet those criteria for what we're looking to invest in, and building against those behaviors and against those different variables that we think drive consumer behavior change.
All great points, and tying that consumer behavior to the changing times has been real important, as we've all seen over the past couple of years. What was it like for you to launch a fund right in the middle of COVID, and then fundraise for a second fund during COVID? What are some of the challenges that you could equate to what it's like for a founder raising money from a VC? Because the process is still somewhat the same.
The process has a lot of parallels and a lot of differences. I'd say, like, just for me, we're raising from different type of institutions and people, and the check sizes are a little bit different. So that's been interesting. Also, now we're doing this. We're fundraising in Zoom's metaverse, I guess, if you will. So we haven't had to do. So fundraising early on was very much. There's a lot of, and I'm sure if you speak to other fund managers, everyone can do kind of fundraising now over a Zoom or audio call, right? That I think has been interesting. I would say our thesis has somewhat, we didn't write this thesis for COVID, but it lends itself well to it because we're playing in spaces like gaming, e-commerce, new media, which is in a way like the metaverse talk has kind of rebranded like the virtual reality and augmented reality conversations. So I'd say that's been helpful to us. So that's definitely a factor in our fundraise. So I would say everything's been really positive in fundraise. The difference, though, I think that we have as fund managers, that we like our thesis is quite clear. Like, we're not gonna invest in a battery company or like some kind of life sciences type company. As a fund manager, don't really know exactly who's investing in this asset class and who exactly to go to. So there's been some interesting things from the last like 2 years, as I talked about the social unrest and things like that happened in 2020. There's been some money that's interested in investing in diverse and emerging managers, and I'm definitely probably a beneficiary of that, and maybe more in the future. But I'd say that part has helped me, and then yeah, I think overall I kind of like it because I don't like hopping on the plane too much. So I think for founders in here, you definitely could get a fundraise done without having to travel and to be honest, I think the investor should probably come to you, because so at least that's how I look at the VC founder relationship. But yeah, I'd say there's some parallels there. But the good thing, I guess, is if you're a founder, is that there's a lot of information and databases and things like that you can find to find an investor that fits what you're doing, and you can read their thesis. Like what I just said to you guys is like, I think on our website to some extent. For I think fund managers to go raise money, it's a little bit different. It's a little bit more of a private network still.
Sure. What you didn't talk about in deploying capital, what's the check size that you typically like to deploy in a first round, in a first investment in a company?
I would say out of fund one, we were doing 250 on average. On this fund two, we're taking a larger ownership stake, so 500 to $1 million.
Excellent.
And I'll caveat that does sometimes, I'm assuming there's a lot of founders here. It's like, don't take a no from someone too personally, because in many cases, the fund strategy, they can't invest like a 50 or 100K check. They have to deploy a certain amount of money.
Right.
And we're finding in this environment, we're finding that now, like, we have to be able to deploy 500K, because it's not worth our time if we're only putting in $100,000, because it's the same amount of paperwork and diligence, right?
Sure.
Yeah.
And you said in fund two, you're going to take more of a lead role in doing that. Where in fund one, were you following particular funds, or what were those relationships like? Were other funds bringing deal flow to you, or were you finding deal flow and then helping find that lead funder?
Both, yeah. And I did spend some time scouting. I did scout for General Catalyst at a point and for BetaWorks at a point. So it was always, I understand that dynamic where we find a company, we can't write necessarily a big check, so we find it and bring it to a lead, and it works vice versa. Sometimes the networks and the people we've co-invested with and we'd like to work with, they'll bring us on because they're like, oh, you guys know product very well, we'd love to have you on. And that's happened quite a bit with some of our really good partners that we work with, where we're not the lead, but they want us to come in because maybe we have gaming or social expertise. We have product knowledge, or we can help the founders hire in a certain category, or for a product manager. I think we're good at that. So we have to have something to offer for other investors as well.
Excellent. What is the difference in your world as you've seen it, because you've been in the corporate venture community in a couple different cases, and now you're in a retail venture firm? Any differences between the way they look at companies, or give a founder on the Zoom here maybe some insights as to what corporate VCs look at versus retail VCs?
Yeah. So there's, I think this answer may change, and I don't know how many we're actually talking to corporate VCs, but I'll tell you why corporate is looking at you. To be blunt, like a lot of them cannot build inside their four walls because it strategically does not make sense. The incentives aren't there to go do that, because if you build inside their platform, they own the upside for the most part. So the reason why they want to invest is because they want, in a way, a look into what's actually happening outside those four walls, and they want an option to work with you. And then there's that. So I would say that's like the corporate development and strategic kind of angle. There's also commercial, I would say, business development side of that, that if you grow into a some kind of entity that benefits their ecosystem, they will want to do business with you. And I guess one thing I left out is they eventually may want to buy you because it's like, it is a build. If you think about build versus buy decisions, I think it's getting, I think not every big corporate company can build, and it's probably cheaper actually to buy. What I learned in the aerospace industry, because I used to have a secret security clearance and things like that. That like besides like building something yourself, the fastest way is to steal technology. And that's why there's so many security clearances you have to clear in order to work on on these things in that type of environment. I would say in the commercial world, it's like I think it's sometimes cheaper to buy it versus build it yourself. You have to think about them stealing your technology, and that's why I mentioned that. Most cases they're like they don't, and it's because it's just not it. I think there's a lot of conversation around that, and founders could be are sensitive to that, and I kind of probably wouldn't be, especially at the stage that we play in, which is like seed. So there's that. I think that's I'll stop talking about the corporate side there, but I think that's the main thing. Corporates will participate in venture capital. Sometimes it's better for them to just invest in funds because it's not something they do themselves, not their core competency, and it's kind of a distraction actually to a lot of corporate teams. But nothing really wrong with taking corporate venture money as long as you know that and you have a good working relationship with the person who's championing or sponsoring your deal. And who knows, it could lead to commercial relationship building within different business units within a corporate company or corporate entity. The difference, I think, for me it hasn't been too much different because I've always worked at a corporate that let us have our own mandate because they understand the restrictions and the guardrails. Processes pose challenges, especially how fast are things moving. And that's kind of the reason why some corporate venture arms are set up, because a typical corporate entity can't move as fast for process reasons. So that's why they have a separate venture team. But I would say it is a lot faster. There's more autonomy with what we could do at a retail, and also we have multiple investors now, not just one to answer to. So we're not so much driven by strategic returns versus financial returns. And that changes a lot of how we conduct our diligence and things like that.
What's been your biggest surprise this year as you've looked at deals, either deals that you've passed on or deals that you've invested in? Any game changers out there?
Gosh, biggest surprise this year. I think for me, I think the biggest surprise, I'm not sure if this is surprising. That's a good question. I would say what's top of mind right now is how I guess how expensive things have gotten. That's been pretty surprising. I know there's been a little bit of a pullback in the public market, so for high growth companies. So we'll see. But in private, it's like valuations are going up like a lot. I had kind of thought we were gonna kind of even out, and I think everyone in 2020 thought their portfolios were going to like zero. I would say more of a surprise last year. It actually accelerated all the areas that I play in, and people ask you how much does luck have to do with it? Like what happened last year was terrible, but I think a lot of VCs got lucky because we had no choice but to work from home and to do e-commerce and to do things digitally, right? And that just opened up adoption to a lot of these things that probably wouldn't have happened for a while.
Yeah, I agree. If you look at your portfolio geographically, are they distributed in different regions, or are you focused in one particular region?
LA, SF, and New York are the most common. We have some in Europe because of gaming. And that's pretty much it, I would say. But yeah, okay. The main three markets, LA, the main cities, yeah.
Do you find that there's a difference in valuation caps between the three cities?
Oh yeah, definitely. I mean, it's always kind of been, I think SF has always commanded higher valuations, and obviously cost of living and talent there and everything is like more expensive. Maybe they're a little better, but things have shuffled around. If the good thing for LA is that a lot of the big funds have moved out here to LA. I think there was some people who moved to Miami and things like that, but we're seeing a lot of people come to Los Angeles, and I think it's good for VCs, and maybe it's a little bit more competitive now, but at least I focus a lot on gaming and interactive and media, and I think LA is the missing thing that others don't have, that LA have, is this kind of creativity around that.
Sure.
So, and all the gaming companies are here. So
exactly.
Yeah.
And LA is the creative capital of the world. It's also the aerospace capital of the world in many cases too. So it's interesting that that as we look at our economy and how it grows, entertainment, content development, all those creative arts are very important to the overall economy, but also to our startup economy. And if you look at the number of companies that are applying to our program, for instance, or that are looking for venture capital, that are coming out of the creative arts world, is staggering.
Yeah, definitely.
What do you think are some of the challenges that presents maybe for companies as they develop from a startup standpoint?
The challenges in terms of, because there's on the creativity, or?
Sure. Yeah. Scalability, marketplace, and determining, markets and how they're going to attract enough marketplace to make it a big enough deal for venture capital to be excited about.
Yeah. I mean, I'd say one thing about venture, which I think, I think there used to be like a bias in a sense about people or founders who don't have the traditional, well, yeah, I went to Stanford and, I was a coder and things like that, and I'm the best background ever. One thing that we actually look for now is like how, a few things we look for actually is like how creative a team could be. I don't think it matters. I don't think I've ever looked at like what school did they go to and that drive my investment decision. And I think like that used to be a challenge, and now it's not so much anymore. It's almost like I feel like there's a little bit more merit now, and that's maybe not a challenge. Maybe it's a good thing, I think. I guess the challenge is right now for founders is that because especially in Los Angeles, because there's been a lot of migration, there's a lot more competition, and I see that in my personal work. Like, obviously we're not a private equity fund. We don't have majority ownership of a company. We collaborate with our VC partners and our network, but because of the migration to here, and I think to New York, I've found and heard that things have become really competitive, and that's what's driving up kind of valuations in a sense, and like locally. I think valuations are still higher, I think, in up north, but definitely some parity now. I think the challenge is to founders is like, on one hand, like, yeah, you can probably meet a lot of the investors in person, or you probably don't have to. On the other hand, it's like there's a lot more remote work happening, so there's more founders right now than there were before, and I feel like it feels like that.
Sure.
Yeah.
And the challenges that founding teams have and do remotely, where they may not be together yet because people are not used to, aren't comfortable getting together or working in a collaborative, in-person atmosphere. That presents some challenges. What are you hearing as far as talent development with your portfolio companies, and how are they addressing those issues?
Oh gosh, yeah. Recruiting's hard, I would say. I think I think a lot of my companies have had challenges recruiting, just because, I mean, one, there's always like, they can just go to, a big company and get paid a ton of money, and those are great companies to go to. The other thing is that if there's also a lot of other startups that have raised a lot of money, and they're just being able to poach, because they have money they can pay you. So I think that's a challenge.
And is that across the board in all kind of functionalities within a company? That meaning, finance, marketing, sales, and technical development?
I think so.
Yeah.
I've just heard in general, like, hiring is the toughest thing right now, and that's why the last 6 months I've been trying to play sort of like resume collector in a way, and try to meet other people besides founders, because I want to meet interesting people who I could refer into my companies down the line.
Yeah, you're almost a search executive in many cases. I lost my train of thought. I'm sorry. As you look at founders, and as you're making decisions whether to invest in a founder, what are those qualities that stand out to you that are necessary in a founder to be successful in the venture marketplace, to grow and scale a company?
Great question. I think a founder needs a lot of grit. It's not a bad thing if they failed a few times and they've shown they've been able to pull themselves out of it. So we look for that. We look for really good product, at least I think product sense. We like founders who are kind of plugged into like what's working for consumers and what doesn't. I think you should be pretty intellectually curious if you're a founder, if you've been working in this industry, because you're always kind of challenging the status quo. That's like why you're raising venture capital. So if you've got interesting insights, interesting information on why your product or service makes sense, and typically to better articulate that, you have to know what's going on in the market and why you're different. I think that's important. There's really like a few things that we look for in a company and in a founder. Like, do we think they have a competitive advantage, right? Do we think that what's like anomalous, kind of to my previous comments, like, does the founder have interesting insight that's really anomalous to status quo, that actually makes somewhat sense and can challenge our thoughts on a market? The other thing is, are they building a company with scale, with a growth mindset? And what that means is, they're like an accumulating advantage or a compounding advantage to what they're building. And the last thing is what we were just talking about, like can the founder attract and retain talent? You know, sometimes it takes a lot of, I think if they can do those things, it probably means they're probably good salespeople and they can get commercial business in. But at the stage that we invest in, I think talent makes a lot of sense, and how people like working with them, because in many cases, I think most of the reasons why startups, a good reason why startups fail, because of a lot of founder and employee infighting. So we look for the attracting talent thing pretty closely as a seed fund, because there's no other really real data or proof points that we can base our investment decisions off of.
Sure. I'm going to throw you a curveball and just go kind of maybe a little bit off topic, talking about the mental health of founders and the environment that we have today. If there's working from home, everything's remote. What are you seeing as far, are there strategies that you kind of see and help with, or point in a direction to keep people's head in the game and not from going overboard?
Yeah, I mean, I wouldn't say strategy. I think everyone, this applies to a lot of people, I think, especially working in this weird environment. Some of us maybe like this, I think, and some of us maybe don't and need the social interaction. And it probably comes down to where you are on the introvert extrovert scale. So on the mental health stuff, I do think that people, this way of new work lifestyle, whatever it is, you can literally work like 100% of your time, and I'm guilty of that. You have to like actually schedule your time off, and you should take time off, and really think about it as like a long-term investment, because if you burn out, you know, it's not good for everyone and for anyone. So you have to like actually block out time to spend with family, friends, etc. By yourself, that's what you like. I think it's important to call your investors, and you know, for the way I like to work with founders, I actually like just having a conversation with them. It doesn't have to be about their business. They can tell me how they're feeling, how they're thinking. We almost act as a maybe not everyone does it, but I almost act as a as a therapist in a way. And I'm not licensed or anything like that, but I know it's important for people to get things off their chest.
Yeah.
And you know, and it's something they probably can't tell their family or kids and things like that. But I'm open to that, especially if you know, because some of it is driven by like how much they work and the type of work they're doing. Also, one not really strategy, but tactical thing you can do is, you know, take meetings outside, and you should take a walk, and you can do the Zoom thing, but you can also do audio. It's nothing wrong with, you know, not being on Zoom and taking a phone call and being outside. And what I think is a really great thing is actually, if you're local to an investor or coworker, do a walking meeting. Like, you'd be surprised of how much energy or the different synapses it fires in your brain, where you could think really creatively when you're outside, and a lot of problems like are solved more elegantly that way. So yeah, those are like some of the things I tell people to do, and I try to do myself. I like, you know, I'm preaching this, but I actually need to take this advice myself. But I tell founders to do a lot of this stuff, and yeah, I think that's important.
Great insights, and it would be great to have you as a partner. So let's talk about that real quick, and then we'll cover some questions that people are putting into chat. If I'm a founder and I think I fit your thesis, what's the best way for me as a founder to approach your fund?
I mean, I take cold emails all the time. I mean, they can email you, email me directly. I'm sure everyone has my email. That's been on the calendar. Just tell me where you met. That's probably the best way. If you think that you fit what I talked about here. Happy to entertain a call, right? Like you said, it's end of the year stuff where everyone's super busy trying to get things out, but I'm more open in January, I would say.
Excellent. All right, very good. I'm going to switch over to some questions now. So if you have a question, please put it into chat or raise your hand so I see it. Roberto, you asked a question in chat. I'm going to give you the opportunity to ask it in person if you'd like, so I don't have to read it.
Sure. Mark, thanks for taking the time.
Yeah.
Very fascinating, some of the things you mentioned. You mentioned an increase in valuations that you're observing lately. Can you tell us, give us a feeling for what kind of valuations pre-money you're seeing in the areas that you're investing in, and how much bigger are they than before? I mean, are these when you invest in a company, are you seeing 20, 30 million valuations or 100 million? And it all varies, depends how exciting the situation is. And is there a certain percent of a company that you prefer? Do you have an idea of what you prefer to take with your investment?
Yeah, good questions. And I'd say, like, the way I'll answer this is that, let me talk about what we've seen in the past. We've seen some of my best companies that we've gotten into, we've invested in at like a 4 or 5 million valuation. I would say if those companies were to raise in this environment, they can probably capture anywhere between 6 and 9 for similar state, etc. And I'll give you an example of how fast I've seen things moved up. I mean, if you're doing anything in Web3 crypto right now, you could raise that 7 or 8 million. That's a pre-seed round. Mind you, pre-seeds used to be like 4 or 5, and some still are. But there's just a lot of capital, I think, and investors now, as I mentioned, who so it's more, so you have pricing power there as a founder. So we've seen that. I would say the most ridiculous things we've seen are, like, I was literally talking to a company recently. It was like a pretty early, I would say, like, interesting space, like somewhat crypto, I guess, related. Talked to them, had a conversation. Oh yeah, they're raising at like 35 something million. It was a pre-seed. That's a lot. 2 days later, followed up. They got more inbound inquiry and a term sheet for 60 million. Mind you, nothing has changed between in that 48 hours besides like, you know, a term sheet, I guess, but nothing material in the business. So yeah, we're seeing a lot. And I would say, to your question on where we're concentrating, we're seeing a huge range. We are seeing anyone from 4, and I know you're recording this, so I think this will be probably outdated and see what happens next year, but we're seeing anywhere between 4 and 15 million in seed right now.
There are some conflicting thoughts as to the size of the valuation that the company looks for. If they're asking for too low a valuation, you start scratching your head. Why do they think their value is so low, right? Yes. And if they're asking for too much, you say, no, it's too expensive for me. So you have to find that middle level where you know they're reasonable and all that. So in view of all this, is there a percent that you prefer to take of a company? Some like at least 20%, some this and that. Is there a number, or you just go with whatever you invest in, what percentage?
We go typically, we target 10 to 15. It's hard to do that now, so we're rethinking how we do that. But I would say on average, I think most funds right now, given like the dynamics of what founders want and who they want, and how they diversify their cap tables, like people are probably averaging anywhere between 5 and 8%. Getting 15% is pretty difficult nowadays unless you have a really big fund, which is why we have to raise more money. So yeah, but I would say, like, on your last point, I actually don't ask for pricing until the end of the conversation, because I don't want it to give me some kind of cognitive bias on quality or the lack of quality of a company. And that's something that I think it's hard to dismiss. So the way I short circuit that is I don't ask until later. So.
Super. Thanks for your question, Roberto. Does anybody
you.
else have any questions that they would like to ask?
Hey, Len, nice to see you again.
All right. How are you, Ellie?
Good.
To see you. And after Ellie, I'll call on Joseph. So, Ellie, why don't you go first?
Yeah, Mark, thank you so much for your time. It was very informative, and we had like a broad idea about your funds. So I'm the founder of a digital ID that protects you from identity theft, even if your personal information or biometric information is stolen. I'm wondering if your funds are interested in the cybersecurity space. And back to the valuation question, with revenue. So is the range between 5 and 15? You said valuation applies also to pre-revenue startups like us, in your view?
Yeah, I would say, well, I guess I'll answer your first question. We don't do cybersecurity. We're like consumer media, kind of, entertainment, if anything. Maybe it would apply if like we think personal or identity stuff is a thesis. It's not a space we know, and we have enough, I think, alpha or inside knowledge on to make decisions. But I would say yes, that does apply. Cybersecurity seems like a really hot space, actually. So there's if your strategy and your team, your background, and I guess maybe if you have any pilots and you're not getting paid, if those are all in your presentation and you have like, you can point to past successes, you can probably command something on the like much higher than 5. I would say maybe average would say like 8 to 10, and it can be pre-revenue. But just the one thing I would say is like, you have to think about that's what you want to do, because there's a double-edged sword for raising at a high valuation. One, you get to keep more of the company and don't dilute yourself early on, but at the same time, you have to be able to raise your next round. You have to you've got to like really meet those metrics, and are you giving yourself enough time to meet those metrics is the question. Because what you could do is, if you raise out like a 6 or something or a 5, you can be like, oh, we need more money because we need more time to execute on these partnerships or these sales and to hire more people. It's a trade-off.
All right. Thanks, Mark. Thanks, Ellie, for your question.
Thank you.
Joe Chavez, you had a question.
Well, first, thank you, Lynn, for everything you've done this year. Happy holidays to you. It's been a while since I've talked to you. I'll move offline because I do have good news for you to discuss as well. In terms of Mark, thanks for the talk. If you like a company that deals with entertainment, interactivity, well, I'm the co-founder of a company called Click Here Media. So one of the things that actually I've been fascinated by is e-commerce. So in terms of e-commerce and entertainment, are you starting to see more of a space in that and total addressable market in the billions, which Walmart's starting to take on with Walmart Live? I guess they're teaming up with Talk Shop Live. It's kind of catching up to what Europe and China are doing, or have been doing for the last years. So I look forward to seeing what you have to think about live stream and interactive entertainment.
Yeah, well, I'm bullish on it, and I've actually heard from some people at like at Shopify agency that live stream is interesting, and yeah, I'm totally bullish on it. I was an investor in a company called Pop Shop here in Los Angeles, which does live stream shopping, and they raised money from Benchmark at the end of last year, and I guess maybe we'll go out again or something. We'll see. But they've been on a tear, and if you look at this company called Whatnot here in LA, they just raised at a crazy valuation at 1.5 billion, and from what I've heard from internal numbers, that
the TAMs are in the billions. I mean, the total addressable market. It's
right.
Crazy what's going on in there. So
in China, Taobao Live, I know this because we know some people there. I think in 2019, 2018, they did $90 billion top line through the live streaming platform. So yeah, and you're seeing right now like Amazon trying to understand it, Walmart doing some interesting things with like TikTok influencers. I don't think they've worked well though. And yeah, so you're seeing, look at Twitch, right? There's like some there's some amount of money coming in through just donations. They're not even live stream shopping. So yeah, it's a thing, and it's you know, the younger generation likes this type of stuff, and it's moving towards there. I mean, there's a challenge of like, it's asynchronous, right? You can't just go on. You have to go on someone's live, but there's a lot of interesting engagement because you guys talk to someone about the product. You have questions real time. It's like going to a store, and you know, those sales reps, yes, are there for you to produce a transaction, but they're also there to sell you on buying something. So your conversion is a little bit different.
Well, I look forward to talking to you. It's a nice little Christmas gift. Lynn's provided me to talk to you. So thanks.
Yeah.
Appreciate it.
Thanks, Mark. One quick question before we go. Nathan from 3DL asked in chat, does your fund have interest in the metaverse Web3 entertainment companies in the Series A space? Kind of a specific thing. So
yeah, we do. Actually, one of ours was recently announced. We just did the seed round of Jadu, which is exactly that. It's their NFTs were trending on OpenSea, and they are a gaming kind of entertainment company where you could own a jetpack or a hoverboard, and if you own a certain type of avatar, you could use it in that metaverse space. Although I would say we do seed, not Series A.
all right. Thank you for your questions all. Mark, any last words to this austere group of people that have spent their afternoon with you?
No, just thank you for listening and having me. I really appreciate it.
We appreciate you too. Thank you for your time.